The American economic engine just delivered a shock that has reset the entire financial landscape. The February non-farm payrolls report is in, and it has detonated every soft landing, recessionary, and stagflation narrative in one fell swoop. This isn't a modest beat. This is a 78% surge past expectations. The unemployment rate fell to 4.2%, defying predictions it would hold steady. This data paints a picture of profound industrial resilience, a labor market absorbing geopolitical shocks and roaring ahead. And in the crucible of this economic fire, one asset has just flashed a signal so powerful it cannot be ignored: silver. In the immediate wake of the report, silver spiked violently past the $90 resistance level, staging a dramatic recovery from its recent shakeout. This is not a coincidence. This is the market telling you that a new regime is here. Let's break down why this jobs number is the catalyst that confirms the unstoppable silver thesis. First, understand what this NFP report destroys. It vaporizes the myth that aggressive tariffs and supply chain reshoring would cripple U.S. manufacturing, despite a 31% collapse in auto exports to Mexico. The manufacturing sector added 24,000 jobs. Companies are not shutting down. They are retooling, reshoring, and rebuilding processes that are intensely consumptive of industrial materials. It shatters the narrative that the Federal Reserve, under incoming Chair Kevin Warsh, will have room to pivot dovishly. With wages holding steady and job growth this strong, the path is cleared for hawkish policy. CME FedWatch tools now show a 78% probability of a March rate hike. This strong dollar higher rate environment is traditionally kryptonite for precious metals, yet silver ripped higher. This is the critical divergence. It tells us silver is no longer trading as a monetary metal alone. It is trading as an indispensable industrial commodity with its own physics, and those physics are governed by one law: industrial allocation. The global transition to green energy and electrification is not a future story. It is a present-day physical reality, consuming silver at a record pace. Solar panel factories require hundreds of millions of ounces annually. Electric vehicle batteries need silver. There is no mass-market substitute. AI data centers are emerging as a new, massive source of demand for silver in cooling systems. These are not discretionary purchases. A solar panel manufacturer facing a multi-year backlog of orders does not cancel a silver contract because the Fed might hike rates. They secure supply at any reasonable cost because the alternative is a complete production halt. Their demand is inelastic. This creates an unbreakable price floor that macroeconomic noise cannot penetrate. While the strong dollar from this NFP report may cap gold's rally, it cannot stop the bidding war for physical silver from global industry. This brings us to the terrifying reality of the paper market. The COMEX, the world's key trading hub for silver, is a house of cards built on promises it may not be able to keep. The latest data shows a staggering 6.8 paper claims for every single ounce of registered deliverable silver in its vaults. This leverage ratio is at a historic extreme. Projections for delivery demands in February threaten to claim more physical silver than is officially available for delivery. This is a mathematical impossibility that must resolve. To resolve either through a wave of cash settlements that destroy trust in the paper contract system, or through a violent upward repricing of silver to a level that brings new metal into the deliverable category. The NFP strength, by cementing a hawkish Fed and a strong dollar, may ironically accelerate this crisis by forcing more paper investors to flee, exposing the underlying physical scarcity to the light of day. The growth in construction and professional services speaks to a building and technological boom that will further strain industrial metal supplies. The resilience in manufacturing confirms that reshoring efforts are real and ongoing. Every new factory built, every new chip fabricated, increases the baseline demand for silver. This is happening while supply is under historic strain. Tariff policies are permanently diverting Mexican and Canadian silver from global markets. Geopolitical tensions are restricting flows from other regions. The supply-demand picture is not just tight. It is critically unbalanced, with annual deficits measured in the hundreds of millions of ounces. So, what is the path forward from this $90 breakout? The immediate move confirms a bottom is in. The violent shakeout we witnessed was the final purge of weak, speculative paper hands. The rally on strong economic news is the sign that strong, industrial-backed hands are taking control. The trajectory now points toward a forceful alignment of the paper spot price with the reality of the physical market. The first major resistance will be the level where industrial buyers have already locked in their quarterly contracts up, zone above $120. The continued physical premium, with kilo bars trading $50 above spot, is a constant reminder of how far the paper price must travel to meet reality. Your strategy must be built for this new paradigm. Your absolute, non-negotiable foundation must be physical silver. This means taking direct possession of the asset in the form of American Silver Eagles, Canadian Maple Leafs, or 1-ounce rounds from the most reputable dealers. This is not a trade. This is the acquisition of a tangible industrial input that the global economy cannot function without. You must avoid paper ETFs like SLV. These instruments are bets on a paper price within the very system facing a potential breakdown. In a true physical squeeze, an ETF share is a liability, not an asset. For leveraged exposure, the mining sector offers a compelling, though higher risk, opportunity. Companies like Hecla Mining and Core Mining with primary operations in the United States are no longer just miners. In an era of supply chain nationalism and reshoring, they transform into strategic domestic suppliers. Their stock performance is leveraged to the rising real price of silver. We are at an extraordinary inflection point. The strong jobs report has given us a clear look at the future. A resilient U.S. industrial base, a hawkish Federal Reserve, and a strong dollar. In the old world, this combination would sink silver. Today, it rockets higher. This is your proof that the game has changed. Silver has decoupled. It is now trading on its own fundamental imperative, the imperative of global industrial necessity. The time for skepticism is over. The data is in. The breakout is confirmed. The only remaining question is whether you will position yourself on the side of physical reality before the paper market's final, chaotic reckoning arrives. The signal is clear. The time to act is now.